The most recent data from the National Pension Commission shows that assets under management of the industry increased by 12.3% year-on-year to 15.6 trillion naira in March 2023. This follows an increase of 12.2% year-on-year in February. However, despite the steady increase, the country's pension industry remains under-penetrated, with a pension asset to GDP ratio at a paltry 7.8% as of 2022. To put this figure into perspective, it pales in comparison to that of Namibia at 103% and South Africa at 84%. FGN bonds, which constitute a significant share of FGN securities, increased by 20%, or 1.6 trillion naira to 9.9 trillion naira as at the end of March 2023. It also contributed about 63% of pension fund assets under management. Investment in fixed income securities has been on the rise, largely due to a hawkish stance by the central bank. According to data, the total number of pension account owners increased by 4.1% to about 10 million. This implies an average value of 1.57 million naira per RSA account holder, slightly higher than the 1.45 million naira in the year earlier. What more can be done with our pension spot, and why is there such low coverage of the potential market for pensions? Joining me now to discuss further is an investment management expert, Abimbola Sulaiman. She's the current executive director for investments at ARM Pension Fund Managers. Abimbola, thanks for coming on the show, and great to have you on the show.
Yeah, thank you for having me. It's a pleasure to be here.
We have approximately 10 million RSA account holders. That's about 9% of the working age population. Given the working population potential, why do we still have such low penetration rates? It sounds like a very bleak outlook for people's future retirement plans.
No, I mean, great point, and this is subject of conversation everywhere in the industry and with the regulator. I think the way the regulation was drafted, it was really targeted at formal sector employees. Over time, you've had improvements in the regulation, but execution has been poor. So if you look at those 10 million people you're talking about, half in public sector and then half in the organized private sector. But if you look at our economy and where people work, there is a very massive gig economy. Lots of people who are self-employed, entrepreneurs in agriculture. The regulation today does not capture that segment, properly, and this is really the vast majority of workers in the private sector. In the public sector, which makes up half of contributors and even half of assets, a large proportion of that is from federal government employees. State governments are still in their infancy in enacting pension laws and complying. So today you only have 10 states of the 36 that are fully in compliance with the contributory pension scheme. You have a further 5 who have defined benefit schemes. So you have a vast majority of state government employees not covered, a vast majority of private sector employees not covered. The regulation is now in place, but execution has been poor, I must say.
And you mentioned the gig economy. So I guess the question is, what structures can be created for people like that, people who are self-employed, to make them see this as something they must do for their future financial security?
Right. So the law for the micro pension scheme, which is what we have now created to cater for people in that category, was only enacted, I believe, in 2017 or 2018 when the scheme, kicked off. So the program is in place. There are people now that are self-employed, that are self-signing up into the scheme and making contributions for themselves. I think on the regulatory side, there is a lot of work to do in terms of thinking about, regulation always lags the sector, and that's the way it is. Thinking about creative ways to address that population. You cannot make it the same way you would ask someone who works at a large private institution, come to our office, bring your proof of employment. The data, we really do need to be creative in thinking about the use of technology, for instance, to push these things out, to ask people to sign up, but also to send that message across thoroughly that this is something you need to do for your future security. Unfortunately, we've been in a very difficult economy in the last 8 years. People are struggling to eat and live well, and maybe are not ready to engage with conversations about what are you going to do for yourself in 30 years. They'll tell you, I'm barely surviving now. But touch wood, as the economy starts to improve and the message starts to get out there, you will see increasing compliance from people in the non-formal sector of the economy.
Yeah, interesting. We had a graphic here that showed social protection at old age coverage, and Nigeria was lagging behind South Africa, Kenya, Ghana, and Egypt. So we still have a lot to do with our pension coverage there. You can see the figures on screen. Egypt, Kenya, Ghana, Nigeria. Look at the age for social protection in terms of coverage. So there's a lot more that needs to be done. Now, let's look at the kind of investment side. Right. If you look at the composition of different asset classes, FGN securities are still taking the lion's share. And of course, we see that some of the macroeconomic policy moves by the CBN, the rate increases, trying to tackle inflation, have actually encouraged inflows into government securities. So what this says to me is that we're still not really positioning PFAs to invest in other asset classes like long-term infrastructure, which are critical for development and which can also reap huge returns. So how is the conversation changing around what PFAs can do?
No, so absolutely. Firstly, there are multiple stakeholders to this conversation. Even the contributors have an evolution to do in terms of what the...
How so?
So I'm getting to...
Because I don't know what my PFA does with my... I have an idea of the risk profile, but I don't know the specifics of the investment.
So if you look on a PFA's website or on PENCOM's website, the asset allocation is there. And you've rightly said that the assets today are really dominated by federal government securities. That in and of itself is not a bad thing.
Okay.
You do want to see that ratio come down. The issue is when these assets are directed to the FGN, are they really going to productive segments of the economy to drive growth, to drive, just general economic development? The way the investment regulation is crafted, because the investment management function in the pension scheme is regulated. It's not like your PFA can go and do whatever they feel like.
Yeah.
So within that regulation, the crafting is such that federal government instruments are the default asset class. You will see minimum to this, maximum to this, and when you run the numbers, you find out you will have a sizable allocation to federal government instruments, and that's not too different to other countries. I think the challenge for us is that the pension scheme has grown faster than the economy for many, many years.
Right.
You want to have those outlets where you can direct new inflows and new investments to. Unfortunately, you're not seeing that significant growth. Infrastructure is an asset class that is permitted and that we have started to invest in. But the way to do infrastructure, remember, this is, people's savings. It's not our money to do what we like with. And so we are investing for greater public good, but not for, it's not, you cannot subsidize investments with pension assets. You have to find infrastructure outlets that are profitable and that are commercial. And so recently, some of the funds that we've invested in, for example, there has been a Lagos to Abeokuta expressway that just broke ground, will be told 18 months construction timeline. There's a Benin to Asaba road as well. All of these projects are funded by, pension funds.
So I have to ask you, you give some of those examples. So are there then special criteria, qualities of an infrastructure project that a PFA, who are typically actually risk averse, would be comfortable
The infrastructure
investing?
has to be able to pay for itself and has to be able to deliver a return. So you cannot have pension assets built on a road and leaving it there. It has to be tolled. And if it's not going to be tolled, there has to be a mechanism to pay back. So the Lagos-Abeokuta road I tell you about, Benin to Asaba, those will be toll roads, and those tolls eventually become investment return for the pension savers. So again, as a populace, when we have to want infrastructure and be willing to pay for good infrastructure that is well done, So again, that mindset shift for people to understand that good infrastructure costs money and that people have to pay for them. Outside of that is that infrastructure investments, by their nature, do not give you investment returns on a daily, on a monthly. It's a long time. Like I said, the money is going to build the road. The road's going to be under construction for 18 to 24 months. Then you start to toll it in 2 years. So if the money is there, you're going to see that amount of money flat for 2 years. But we've come to this environment where pension savers are saying, what's my return in the last month? How much has my money grown in 1 week? And that mindset has to change. You have to understand that investments take a long time, good quality investments take a long time to yield fruit. So it's that quest for short-term return that has driven behavior to leaning towards short-term investments that give you kind of a daily yield, like federal government bonds.
And you make an interesting point, because I think a lot more understanding and education of the nuance of investing. And I think a savvy investor typically has a portfolio of different investments that have different return horizons. But are there any other interesting infrastructure asset classes or any other new types of innovative ways of investing that you see emerging on the horizon? What would some of these be?
So I'll tell you some things that are already in the regulation that will grow and some that are not in here that we'll think about. So on the real estate side, we're seeing quite a lot of interest and development. We have to invest in real estate via funds, but we're seeing many reputable fund managers now putting together real estate funds, whether for development or sort of mortgage type funds, a national housing fund. So I think increasingly there is vast opportunity there. Outside of that, I think when you look at the local economy, you've seen significant growth in the tech sort of startup VC type space. Again, you will see fund managers start to put together creative funds that can harness the potential in that space. We're already investing in private equity, but largely in the sort of growth equity type segment. So now you will see more interest in sort of venture capital, startup, fintech, all those places where you have opportunity. I think that one elephant in the room that we all haven't talked about is just international diversification.
So going into other markets. The South Africans already do that. Absolutely. The Public Investment Corporation of South Africa has been investing in others.
It is a risk management tool. You don't want to have this very heavy home country bias, like all your money is stuck in Nigeria. It's a difficult conversation to have because people say we need all this investments in this country. Why would you go and invest in other countries?
Is there pensions in international markets in terms of the investments?
The pension regulation today does not allow any PFA to invest internationally directly. The only international investments we can make might be via private equity funds, real estate funds.
Limited partners or institutional investors.
And those funds can only invest up to 40% of their assets outside Nigeria. They're still predominantly Nigerian funds, but that can take advantage of opportunities outside Nigeria up to 40%. And then in the Eurobond space, where we're trying to find some foreign currency exposure in our investments to protect us from the types of devaluation that we have seen recently.
And I think you bring us to an interesting point. I wanted to talk about your thoughts about how some of these macroeconomic dynamics may be impacting an investment strategy for a PFA like ARM.
Absolutely. I mean, I heard you say earlier the scheme only grew 12% last year. If you look at the data pre-2015, the pension industry was growing high double digits, 20% annually, 25% annually. Part of that is investment return, but another half of that is new contributions. The economy has to be thriving for any business to be thriving, whether you're a pension fund or something else. So job creation has been pretty much non-existent over the last couple of years. So you're not getting new contributors coming into the scheme. It's new contributors that bring assets growth, and that's
in fact, unemployment is about 33% in the economy.
Is through the roof, and people aren't seeing wage increases. So the way the pension scheme will grow is more people contributing, or the same people contributing, but now contributing more. That comes from wage increases, comes from people getting promoted. It's been so slow. And then the investment outlets as well, the companies that we invest in, they're having such a tough time growing, cost pressures, cost inflation, and so investment returns have been quite difficult. But there is hope on the horizon. We're very optimistic about some of the changes we've seen recently, and that economies are going cycles everywhere in the world. It's not just us. You will have contractions time to time. You will have expansion. You just hope that we are not exacerbating our own problems. So we've had multiple years of weak growth. Growth will come, things will get better.
Yes, I have to ask you this question. So which one of these macroeconomic indicators keeps you awake at night? Inflation, FX devaluation, or interest rates?
It's inflation.
Inflation,
yes. It's inflation because we put our contributors first. As a business, other things will concern us.
Yeah.
But in terms of the people that we manage money for, inflation is your enemy if you're saving for retirement. We are here building a pot for you to retire on, but we do not want the real purchasing power or the value of the savings to be so diminished. And so inflation really concerning for the savers who
are there ways of managing that risk in terms of the portfolios you're managing? What are some of the structures?
So back to the point you made, it's a big risk for the portfolio to be so heavily skewed to fixed income instruments. You want to have a portfolio that will respond to inflation. So real estate, real assets, infrastructure, equity type instruments that can try to keep up with inflation. Sometimes they don't, but they'll do a better job.
Of course, except of course we see a hike in interest rates, which could then change the game in terms of how you balance that portfolio.
Absolutely, absolutely.
So I mean, what opportunities do you see for those who have pensions, who have retirement savings? What else can they do to leverage the wealth of that? We saw PenCon release that regulation last year that said you could use 25% of your RSA towards an equity for a mortgage. Fantastic. Yeah. But one of the things that was discovered is perhaps the addressable market of those who had enough to put towards equity was low. But could you perhaps speak to that and then talk about how else people can leverage their retirement savings for financial security?
So today the mortgage one is the most groundbreaking. People wanted that and now it's in place. You're right that, it's still a small segment of contributors that can benefit. You need to have contributed for 5 years. You need to have enough in your account, to be able to buy a house. Maybe that's a big challenge in urban areas like Lagos, but there are other segments of the country where actually, housing is a bit more affordable and people can take advantage. Another good thing the regulator has done is to allow for those who are couples can make a joint application if they both qualify. So if I don't have enough, my partner doesn't have enough, but together we might be able to do something. So we've started to see people take advantage of that and it's working. Like I said, we will come out of this cycle. We're in a very long-term business, so 30, 40 years. So things don't look so bright today, but we're very hopeful that as things evolve, you'll see more and more people be able to take advantage of that for home ownership. And that's a big step, really, in preparing for retirement. Another thing we don't talk about a lot is the additional voluntary contribution scheme. I always try to tell people that this is a tax-free savings scheme, right? You make any additional contributions that you make into your pension fund, you make that before taxes. So it is tax shielded. So again, that's one thing you can take advantage of. Why pay higher taxes just to spend the money today? If you put this money aside, you get a larger pension pot, more returns, and you reduce your tax burden. So for me, for the tax shield, the AVC is something that people should consider doing. And whatever additional contributions you make can be withdrawn before retirement. It doesn't have to stay till you're 60 or 65, and can also be part of the contributions you make for the mortgage withdrawal. So if you're looking, for instance, to quickly speed up the value of your account to be able to get a mortgage, you can do the AVC and you do that before taxes. So then you're saving faster than paying your income tax and then saving from your bank account.
Yeah, interesting. And as Nigerians and Africans, there's always that question between consuming now, saving money that could be eroded, whose real value could be eroded by inflation over the long term. So I'm going to shift gears a bit. So recently, back in May, PenCom said it had recovered about 24.5 billion naira of contributions from employers that should have been remitted to RSAs. And actually about half of that was penalties. I mean, what is going on? And, is there anything that PFAs can do around that? Are you sort of advocating for faster remittances by employers? I mean, it's a staggering amount of money.
So look, we're scratching the surface. It's a staggering amount of money, but we're really only scratching the surface. If you think about it, the entire pension scheme is 15 trillion naira. So
it could be double.
So 25, it could be more than double. Yes. 25 billion naira is really, a pin drop in that ocean. It's important that that work is done because sometimes you really see bad behavior from some bad eggs. The vast majority of employers are compliant and try to be compliant. There are a few bad eggs here and there, some who actually deduct from contributors and don't remit, and others who just don't deduct. And again, as a citizenry, we have our role to play. You will find some employers where the employees themselves are saying, I don't want to save, I want all my money. And so there's a lot of education to be done. And PenCom is doing that. I think the bigger thing to do is to get more people compliant. We had this conversation around taxes as well. It's you can flog all the people who are compliant now, but not compliant enough. But the bigger win is to get more people in the booth, into the scheme.
Absolutely.
So the private sector, the non-organized private sector, the state governments, really important, and local governments to start to contribute for their employers for the greater good. It's better for all of us.
Yeah, interesting. So we're wrapping up just about now, but I want to get your thoughts about how the pensions industry is evolving. We've seen some move in the rankings table. I know ARM Pensions is the third largest, I believe.
Oh no, please, we're the second largest.
Second largest. But recently there was a major acquisition. Do you see opportunities for growth and expansion of your business and in the market? And what are some of the things things that you think will be interesting?
No, so consolidation is here, and I believe it's here to stay. The top 5 PFAs control over half the market. So you have this very long tail, and it's normal evolution in the industry. The pension industry is very young, right? The the law was enacted in 2004, so not yet 20 years. So it's normal evolution. We saw it in the banking sector, we've seen it in insurance. It's definitely going to happen in the pension space as well. I think the smaller operators are going to be thinking about building scale to be able to compete with the big names that are coming in now. And the larger operators too have really big ambitions in terms of what they can do in service provision. And for you to be cost effective, you want to have scale. You know, we want to have branches in every state. We want to be able to provide excellent service to our to our contributors, and that costs money. So one way to do that is to really consolidate and have the scale to make those investments.
So can we expect any major acquisition announcements from ARM?
No, we are a serious player in the industry.
So you're always looking for opportunities?
We are always looking for opportunity, organic and inorganic.
Yeah, of course. And what more do you think the government can do to really encourage this industry to grow?
I think the biggest task ahead for the new administration on this scheme is to really find, you know, very creative and capable regulators. You know, at the end of the day, many industries live and die by, you know, what regulations are put around them. You need a healthy balance between sort of that regulatory mindset, which is kind of risk management and holding you back, and the innovation that comes from the private sector, where we're trying to push boundaries and thinking about how we can do things better. So you want creative regulation that's thinking about how to do things differently to address all these challenges that you've highlighted. We cannot afford to kind of rest on our laurels and think about what we're doing now and just compliance to now. Regulation needs to be future focused and future minded. And so we're looking forward to seeing how the new policies in this administration will affect us, but also the kind of leadership that we start to see brought into the pension industry.
Yeah, and I think one of those pieces of regulation is diversification, including geographical diversification. So great chatting with you, Abimbola Sulaiman, Executive Director of Investments, ARM Pensions.